Hello, and welcome back to Tax and Financial Matters, the channel where we discuss various topics related to tax and financial matters. Are you curious about the European Union's Mandatory Disclosure Regime (MDR), or also known as DAC6? Today, we're providing a beginner-friendly overview of this important tax directive. So, let's get started. Before we dive in, don't forget to like this video, subscribe to our channel, and turn on notifications to stay updated with the latest financial insights. Now, let's unravel the mystery of EU MDR/DAC6. DAC6 stands for the sixth version of the EU's Directive on Administrative Cooperation in the field of taxation. Implemented in 2018, its primary objective is to promote tax transparency and fairness among EU member states. It does so by requiring intermediaries and taxpayers to report certain cross-border tax arrangements. You might be wondering who these intermediaries are. They're professionals like tax advisors, accountants, lawyers, and banks who are involved in designing, marketing, organizing, or implementing cross-border tax arrangements. When intermediaries can't report due to legal restrictions, the reporting obligation falls on the taxpayers themselves. Not all cross-border tax arrangements need to be reported, though. DAC6 focuses on those with specific characteristics called hallmarks. These hallmarks indicate that an arrangement could be potentially aggressive or abusive in terms of taxation. There are 5 categories of hallmarks, labeled A through E. Category A includes generic hallmarks linked to the main benefit test, while categories B, C, D, and E consist of specific hallmarks, each targeting different types of arrangements or transactions. In a future video, I will be going through the specific hallmarks in more detail and provide practical explanations to illustrate how and when DAC6 may be applicable. Now, let's briefly touch on the reporting process. Once a reportable cross-border arrangement has been identified, intermediaries or taxpayers must report the arrangement to the tax authorities of their respective EU member states. This information is then automatically exchanged among tax authorities within the EU. The reporting timeline is quite strict. Intermediaries or taxpayers have 30 days to report from the day the arrangement becomes available, ready for implementation, or when the first step in implementation occurs. For ongoing arrangements, they must be reported periodically, usually every year. So, what happens if you don't comply with DAC6? Non-compliance can lead to penalties that vary across member states. It's crucial for intermediaries and taxpayers to be aware of their obligations under DAC6 and the penalties associated with non-compliance in their respective jurisdictions. Conclusion. In summary, EU MDR/DAC6 is a crucial directive aimed at promoting tax transparency and fairness across the European Union. By understanding the hallmarks, reporting obligations, and penalties, intermediaries and taxpayers can better navigate the world of cross-border tax arrangements. We hope this beginner-friendly overview has shed some light on the EU MDR/DAC6. If you found this video informative, please give it a thumbs up and subscribe to our channel for more content on tax and financial matters. Until next time, stay informed and take care.